Hello everyone, welcome to this week's crypto market report for Brave New Coin. I'm your host Carl, lead trader and portfolio manager at Technique Capital. Quick disclaimer, this video does not constitute financial advice, and I always recommend that you do your own research and draw down your own conclusions. Our agenda today consists of an overview of the global macro events affecting both the stock and crypto markets. Once that's reviewed and you understand my view on the exceptional times we're in, only then we can dive into the Bitcoin models and overview the long-term, mid, and short-term technicals. Since its creation, Bitcoin has never been through this unprecedented set of macro, global, and financial events. As you see here, we have like 10 potential macro events that have either hit us or about to hit us hard, right? And question is, what do we need to ask? What we need to ask yourself is Bitcoin going to stay correlated tied to the stock market, or it will finally decouple from it, which we still do not have any tangible proof as of yet. And the average influencer or on CT or crypto Twitter or social media won't know either because we haven't been there. Nobody has been there. Unless you were trading in 1980s and you were on the dot-com bubble back in 2000 and year 2002. So yeah, if Bitcoin remains coupled with equities, namely SP 500 and Nasdaq, and they continue to sell off much lower into an extended or multi-year bear market that would last into 2023, and all the Bitcoin current models that we've been looking at that have been established in the past 10 years fail, what would we do, right? We have to look at that. We can still look at if those models stay relevant and how we would trade through those, right? So we have to, so nobody knows with certainty, and the point of this video and market reports will bring you some clarity and help you manage risk and conserve your capital. So let's start with pandemics, right? And roughly, COVID hit in 2000 and lasted up until early 2022. The worst of it has passed, hopefully. But this kind of event has not happened, not at this scale, not since 1980, 1920, when the Spanish flu hit pretty hard. So the point I'm trying to put in here is we need to look also and compare markets from back in the days. Yeah, there are some differences, but to be honest, this hasn't happened in 100 years. And we just got COVID, the COVID pandemic hitting us 2 years ago, well into till recently. And then, on top of that, then you have the US-Ukrainian proxy war with Russia. Now, some of you might say that's not a big deal, Carl. Well, you know, um, I've posted several tweets since February about this. I pulled up some statistics and made my own research, and I've been proven pretty right so far. I told you that we would see the SP 500 lose 20 to 30% from its all-time high, and guess what? We lost 20% and we hit 3,900 SP 500 a couple of weeks ago. Now we're getting a really relief rally. So yeah, Bitcoin has been following pretty much the SP 500 or the Nasdaq as well. And did we finish? Did we bottom? Personally, I don't know, but I don't think so. Right? I don't think so. And most statistics have shown that every time the U.S. was involved in a war, proxy war, and a direct war, we did fall into recession and had a drawdown of 20 to 30% from the all-time high. That's just with the war, and a mix of recession. Not all of these from 1 to 10, right? So that's something to look at, And then you have the consumer high debt, and I'm just going to keep it simple on this one. I'm not going to dive too much in details. Probably another video for all of this to go deep down in details. But many consumers, after paying off their debt during the pandemic, thanks to the stimulus check and all the unemployment, you know, um, pays that they got in the U.S. at least. Many people got $600 and $400 extra from unemployment. The recent research has shown that consumers are in the US are racking up debt again on their credit cards. And that's due to the surge in prices driven by inflation. And consumers are having a hard time to survive paycheck to paycheck. And then, so in my opinion, because of this and because of the high rate hikes, the rate hikes we're seeing, we're not going to see consumers anymore, rushing in and spending, investing in stocks, like they did in the past 2 years. And let's jump to the pretty much the cost of living, which was I was talking about right now, is the cost of living has significantly gone up in the past 2 years globally. We're feeling the pain of inflation very hard with higher prices of food and groceries, gas and gas or energy, and taxes and other necessities are going up. And the worst part is our salaries are not catching up. And yeah, we people are in debt. The prices are extremely high, and people, got pretty much screwed with the latest drawdown in the stock market. Like if you want to look at Netflix, if you invest in Netflix in the past 2 years, most likely, um, either you're sitting in loss because Netflix has retraced roughly 75% from the all-time high, and then pretty much a lot of noobs who bought in and thought they would just get rich. They just got caught. And then now they're waiting. They can't afford, to pay their bills. They're having hardships, so they're probably waiting for a relief bounce. We're just having right now in the equities to sell and try to pay some bills. They're not going to stay invested. There's a lot of fear in the market, right? And then you have inflation and stagflation, hitting us pretty hard. I'm not going to dig deep into this, but yeah, pretty much there is some talks about growing fears. We're not there yet, but there's fears of stagflation, which is growing recently and talked about by many economists. And that's reminiscent of the 1970s, mainly in 1980s, when the Feds tried to do a very aggressive rate hike. And stagflation, there's no real definition for it, but it's informally, it's when the unemployment rate reaches at least 5% and the consumer prices have surged 5% or more from a year earlier. Now, currently, the U.S. consumer prices are up 7.5% over the year that ended on January 2022. That's so we're halfway there. Now we just need the U.S. unemployment rate to hit 5%, but currently I think it's 3.6. So we're very close, guys. We're very close. All right. And then you have the Fed monetary tools. It's another video. I'm not going to dive into it, but you've seen the Feds try to save the economy to try to, with quantitative easing that started in March 2020 after the COVID crash. They start printing unlimited money. Then now they ended quantitative easing in March 2020, and then they started rate hikes. And yeah, I mean, they're trying to save the economy now, but um, by controlling the inflation. But then, if you control the inflation too aggressively by, getting the rates very high, um, to control that inflation, they're going to bring us down into stagflation. So it's a tough spot for the Feds. And then you have the fears of recession. And recession, guys, is going to hit sometime this year. I think the first quarter already passed, and the economy already shrank 1.5%. Now we need another quarter to pass, and the GDP again shrinking. Then we're in a recession. And then when we hit that point, we might either have bottomed by that time, could be like 3 months from now in September, um, or it could last a little longer, maybe go into December until that's confirmed. So then you have the housing bubble that we're clearly into in the U.S. and maybe globally. The prices of houses have been skyrocketing. I mean, depends on where you live, but it's at least 20 to 30% price appreciation. And yeah, and right now there's this slowdown. Nobody's buying anymore because houses are super expensive and the interest rates are very high. So we're heading, guys, into very unprecedented territory here. And then you have the tech bubble or dot-com bubble bust, which we are very much, right now you saw now, right? I spoke about Netflix being 80% or 75% down from the all-time high. That's very reminiscent of the tech bubble back in year 2000. That tech bubble bust pretty much lasted, the recession at that time as well, at the same time lasted 2 years. So we got to be prepared and be mindful. We don't know. This looks like very well we're heading in another tech bubble. We're actually, not only that, all of those points are very possibly going to hit us maybe at the same time. And then you have the US dollar, DXY, rallying super hard. And now it's sitting roughly at 102. I foresee that in the next 3 to 4 months, it's going to rally to 112 and push the stock market deeper and, possibly crypto markets as well. All right, guys, let's overview relevant Bitcoin models and taking into account that Bitcoin is still following the 4-year cycle. So let's start with the moving average, 200 weekly moving average. Um, Pretty straightforward, as you see in previous bear market, where you see the dark blue dots. Whenever we bottomed every time closer to 200 weekly moving average. So in 2015, we bottomed $200. I actually traded at that time, and I saw the capitulation bottom. I called the bottom around $160. So we overshot a little bit below that level. And in 2018, the bottom was at 3,200. And fast forward till now, you want to look to dollars cost average in or start to buy in closer to 22Ks. Now, as you may have followed on my tweets and on my Discord channel, um, the first bottom that I was actually looking for, based on my monthly calculations on the Bollinger Band, and it was a 40% drawdown from the monthly Bollinger Band. So it was at 24Ks, roughly, give and take. We stopped very close to it. It was at 25,000, 400 on most exchanges. So $400 away from the 24Ks range. I still think that we will get a second leg down and go down to 22Ks. So no rush. If you want to start to DCA in, I would suggest from 25Ks and under, and closer to 22Ks will be the ideal region. Not like other influencers who have been telling to a cost average in from, mid 40Ks and 30Ks, especially 35 and above Ks. All right, guys, let's have a look at the Bitcoin Rainbow Price Chart Indicator. The takeaways from this chart is, previous mega bulls, the past 10 years, we overshot the red area, which is a maximal bubble territory. Now, as the market has started to mature through the years, we were well bound within the red, the red part of the rainbow. And then most recently, as we matured and, quantitative easing and, kicked in and ended, we literally stopped at the orange area, which is just the bubble area. And it's quite never happened before in history. So, but the market again is more mature. It's coupled more with the stock market more than ever. So maybe that's why, And we pretty much had two rallies. Well, another rally after we peaked here at 64,000 roughly, and when that hit 69,000. So where do we go from here? Well, if we want to, we think that the model is still valid. We want to start buying. You could start, buying slowly here the next few months. The green area. That said, and we've seen Bitcoin going down to bottom two levels closer to the blue level, and that has been better by area through the years. Now, that would mean, roughly, the area is 24, 25Ks, and the bottom blue area, which could happen if we crash lower, because of the macro events globally that we're seeing, which are unprecedented in history. We could hit maybe that blue level at $14,000 or $16,000. Those are great areas. If you have cash at hand, you want to keep some dry cash to buy the dip, that will be the area. All right, hold waves. So not my favorite chart, to be honest. I know a lot of people on CT look at this, though I'll give a good summary of what I would look for here. Although again, it's not my favorite chart. So if you look at the previous bottoms here, you would want to see holders starting to come in here, like closer to the bottom. You would see a spike on the, what is that? That's the 1 month to 3 month holders, the 1 week to a month holders, and 3 to 6 month holders, right? Like we've seen in 2015 at the what was this? That was like $100, $200 level, yeah, bottom back in 2015. Now, if you go look at the 2018 bottom at 3,300 and or so, you would also, notice here, the holders short term started to come in right at those levels. You see all those spikes coming in nicely here. So that's what I want to see personally, and I don't see that here, guys. I don't. There was a little spike here, but I actually was at the top. So people started buying at 60Ks, and we've seen a lot of actually funds, hedge funds, and some big CT, influencers started buying there, which quite says it all. They bought the top. Quite embarrassing. But anyways, I sold roughly around 49K after holding from those levels here, and way long before. So right now, I don't see anything that tells me that we have a spike here and that we're near a bottom. So I would say wait it out. Nothing is there yet that shows that we're at the bottom. Cool. All right. All right. The Puell Multiple. Again, same thing, similar to previous models. Um, Based on the 4-year cycle, you would see also when we topped, back in the days when the market was less mature than it is, the market cap was not as big. Yeah, when we topped on the mega bull, we wicked well within that red area. And when we bottom, we put a final bottom, we saw a wick well within that green area. And same thing for 2012, and same thing for the bottom of 2018, and the mega bull of 2017. Yeah, we saw that wick in the red area. So now the only thing we didn't see in the latest bull market, mega bull, is we barely hit that red area here. That shows that we top around May 2021 or April 2021. Then we had a wick down to the green area, which never happened really before in previous cycles, so we never went for it right away. And then that was the bottom, close to 30Ks, which I covered back in the days at that time when it happened. I actually called 30Ks ahead, maybe a few days or a week before on Twitter. And then here we are very close to the green area, so we could very well wick to the tip of it, or we can, because of the global macro events, we could go deeper in there in the next few months into the year end. So there's no guarantees, but I think if you believe the macro events are super bad as I do, then this is quite possible unless Bitcoin decouples from the stock markets. So bottom line, you can start buying closer to 25, 24Ks in an incoming month, or you can buy closer to the 22Ks, and I think if we hit closer to 22Ks, then we would hit in that green area, at least the some good portion of the top of it right here. Um, Now, if we go deeper, I think that then we were looking at 16 to 14Ks. And then you would need really to follow the macro events there globally. And those events really bringing really a rough time to, a lot of investors and a lot of pain ahead. So that's possible. So keep some dry powder for this, guys. The pi cycle top indicator has been great indicator to mark the tops and try to call a bottom as well. And the past 10 years, you see every time there was a green dotted line that called that indicator called the top. So going on from April 2013, and then the next bull market topped at in November 2013. This is where actually I started trading for my first time crypto. And then in 2017, it called the top quite perfectly at 19,000. And recently, I mean, yeah, this bull market called it around April to May. Though here things look different, right? After that top, we didn't really quite go down hard. We actually rallied. We took out the previous high, then trapped a lot of players and investors, and then went back down here. So a little much different here. And anyways, you can't expect the market to be mimicking the same or previous cycles, really. So here we could be looking at literally different price action as well. Now, how do we know that if we bottom or not? So you want to look here, and you see that yellow line that is the 111 moving average. So we could pretty much every time we bottom, every time we touched it, actually, if you look here, and we're still during the bear market, we actually got rejected. And this is exactly what happened like after we topped around November, December. And each top, if you guys look back, each top happened in closer to December, November, December, or January. Yep. So, and this is what happened on the second top here, right? November came, we topped. Everybody thought we were going to 100K. And I was same here, man. Same here. Until we broke down, I thought we were, still going up, and maybe we would go to 100K. Although December, was getting close, I thought we would make it. We didn't. And I sold around 49,000 after I saw that's done. And yeah, from here you see the yellow line came, got rejected on this rally around like 48Ks or 47Ks, and then we are selling off below that moving average in orange. So how do we know when we bottom? Well, we're gonna have to give this few months, no rush, and we can either be still on the way down, or we could have bottom. It's not very clear from this indicator, but if we're there for like 3 to 4 months and we do end up touching again that moving average, then I think it's a good time to buy. And it happened also in previous bear markets when we bottom. So no rush. You have time. Let's wait and see. All right, let's overview the aggregated funding rate and the history of that, um, indicator. So let's have a look here, and you notice. Too bad we don't have a lot of history going back to 2018, but you notice here that the funding rate was spiked super deep back on the crash of March 2020, and that marked the bottom, capitulation right there. And then fast forward to May 2021, went down to 30Ks, 28Ks. We had a large, massive spike as well, not as big as this one, but it's quite big enough, and that marked the capitulation bottom. Now, if you fast forward here, there's nothing that indicates that we've capitulated yet, which again comes to my point that I've made it clear in the past month, that I think we still have not bottomed and we have more pain ahead, possibly another leg down closer to 22Ks as such. I'm going to overview the stock to flow model. Typically, I never liked this model, but you know, because the accuracy of it is not really there. You can't. The takeaway is, you know, that it always had is the ranges are way too large, and you couldn't really, you know, make a good call out of it. So this seems that it's, you know, can't depend on this. Just want to put it out there that you know, it's kind of broken. And as we have a lot of macros and we're coupled to the stock market and a lot of macros are coming in here into play, yeah. I mean, the stock to flow model suggests 100K right now, but we are far away from that near, you know, 29Ks. So, yeah, not much really. I wouldn't look at this, to be honest, for anything. Yeah, will we go to 100K again? Yeah, of course. Now, do we have more downside? Possibly. So, yeah, I'll leave it to that with this model. Probably will not review this again.